Are you struggling to make sense of some of the securities registration regulations on the exam? You're trying to get an overall framework, figure out where everything fits together? Then you're in the right place. I'm Brian Marks, the president of Notman Marks Financial Training, and welcome to the Vault. During today's lesson, we're going to cover a 30,000-foot view of the nature of securities registration. What's an IPO? What's a follow-on offering? What's a private placement? What does it mean for a company to be private anyway? Let's go through that. We're not going to necessarily talk about all the details of the regulations. I just want to give you an overall framework that I think will help you. So what does it mean anyway if a company is a private company? What does it mean that the company is a private company? Does a private company have stock? Absolutely it does. Absolutely it does. Who owns stock of a private company? Employees might own stock. Founders of the company might own stock. Early institutional investors. Maybe I'm an accountant and I've provided some professional services for the company. They give me stock. What are some examples of private companies? And this is as of 2024, so maybe some have gone public by the time you're watching this, but Chick-fil-A is a private company. We all love to eat Chick-fil-A, but Chick-fil-A stock does not trade publicly. Wawa is a private company. If you like a hoagie, you're from Philly. Wawa is a private company, family owned actually. Again, what does the family own in Wawa? They own stock. They own stock. SpaceX, Elon Musk's space exploration company, is a private company. What does Elon Musk own in SpaceX? He owns most of the stock of the company. So the company does have stock. How many shares? I don't know. Maybe SpaceX has 100 shares of stock. And maybe Elon Musk owns all of them. So what does it mean that the company is private? It means their public float is 0. That's their public float. That's the percentage of the company that trades publicly. So the company does have stock. It just doesn't have publicly traded stock. Can I get shares? Can you get shares? If you're a regular investor, you're probably not going to be able to get shares. If you don't work for the company, if you're not a wealthy investor, if you're not an institutional investor, mutual funds can invest in private companies, though. Hedge funds can invest in private companies. Pension funds can invest in private companies. So, Brian, give me something real. Relate this to something I might know. Well, are there any TV shows out there about private companies selling stock? It'd be kind of weird if I asked this and the answer was no and I just moved on, right? Well, there is. Shark Tank is a show about private companies selling stock, right? If a company says, if somebody goes on Shark Tank and is talking to Mr. Wonderful and talking to the sharks and saying, I'm selling 20% of my company for $3 million, that what they're selling, that is actual stock of the company. So if this company has 100 shares, what the owner is offering to Barbara Corcoran or whoever it is, or Robert, right, is offering 20 shares. That is stock that is being offered. Okay, so private companies do have stock. You might, well, Brian, why? So why would a company ever go public? What's the point? What's the benefit of being a private company versus a public company? Well, being a private company, you answer only to yourself. There's no public shareholders who are going to drive the stock up or down, who are going to have an opinion, who might launch a proxy battle. You're generally out of the public domain, which gives you some freedom to make longer-term decisions. Why might a company eventually go public? When a company goes public, it's called their initial public offering. It's not the first time they've ever sold stock, because they might have sold stock to Mr. Wonderful on Shark Tank. They might have sold stock to a pension fund or a hedge fund. It's the first time that stock has been sold to the public. The public. A company might have been around for 25 years before it IPOs, and maybe it's done 8 stock offerings in the private market, but this is their initial public offering. It's not their initial offering of any time. It's their initial public offering. Why go public at all? You might think, well, Brian, it sounds pretty cool to stay private. You own a lot of the stock. If you're the founder, you don't have to answer to public investors. Maybe you don't have to make as many disclosures under SEC rules. That's all true. So absolutely, there are some benefits to staying a private company. However, there are also some benefits to going public. One is it's a liquidity event for founders and early investors. If I work for Chick-fil-A and I get paid in stock, it's not that easy for me to sell my stock. I can't just call my broker and say, hey, sell my 20 shares of Chick-fil-A stock because there's not a public market. So it gives a liquidity event for founders and early investors. Another reason is you might want to access more capital. If you want to raise billions and billions and billions of dollars, you can do that in the public market. Think about how many investors are out there in the universe. But if you've been private for 20 years and you've been accessing the capital of hedge funds and pension funds, you might have trouble raising more money. So you can raise a lot of money in an IPO. Also, eventually you might have to. Once you have over 2,000 shareholders, so if you've been private for a long time, but you have tons and tons of shareholders, eventually, once you have 2,000, the SEC says, you know what, you got to start making public disclosures anyway. So a company at that point will decide to go public because you're going to get all the disadvantages of being public. You're going to have to make public disclosures, so you might as well raise some money. And so let's say a company does go public. When a company goes public, is it selling all of its shares? So if the owners of Wawa, the family owners of Wawa decide to take it public and they own 100 shares, are they selling all 100 shares to the public? The answer is they are not. They are not. They do not sell all their shares. The percentage of shares that trade publicly, that's called the float. We're going to talk about that in more detail in a little while. When a company goes public, does it sell all of its shares? Absolutely not. It does not. So if the family owners of Wawa decide they're going to do an IPO of Wawa, do they sell every share they own? The answer is absolutely they don't. The percentage that they sell that trades publicly, that's called the float. All the shares together, so the shares that the Wawa family owns, their last name is not Wawa, by the way, the shares that the Wawa family owns or the Chick-fil-A founders own, and the shares that trade publicly, that's called the number of outstanding shares. So these trade. The outstanding shares, some of them trade, and some of them don't trade. When a company goes public, can some of those early investors sell their shares? Sure. If the sharks invest in a company on Shark Tank, and then that company eventually does an IPO, does the company allow some of those investors to get a liquidity event? Absolutely. Those are called, what that's called, shares that are owned by private investors that are sold in an IPO. Those are called secondary shares. Secondary shares are sold by other investors versus new shares sold by the company. You said, Brian, well, what about the company raising capital? Well, access to more capital. When a company is selling new shares, those are called primary shares. Primary shares. So let's go through an example. So let's talk about the Facebook IPO, now called Meta. Who knows what will be called by the time you're watching this video, but Facebook went public in 2012. For context, I put their prospectus on the right side of the page here. This is the cover of the prospectus. This is a 200-page document. Pretty large transaction, right? 420 million shares being sold. Doesn't get much larger than Facebook's IPO, one of the largest IPOs of all time. But let's talk about some details. A lot of this is actually written on the cover page, but I know it's small. But you can see here, Facebook is offering 180 million shares. But wait a second, there's 421 total. Oh, selling shareholders are offering some shares. So the total is 421 million shares, which consists of 180 million being sold by Facebook to raise money. Those are primary shares. And 241 million by selling shareholders who are getting this nice, gorgeous liquidity event, probably throwing a pretty big party to celebrate. Who are those selling shareholders? Well, you could look later in the prospectus, which I did. I didn't put the 200-page prospectus up here. If you want to print it off, have some reading material, go ahead, have a party. But I've given you some examples of who are the selling shareholders. These are examples. It's not the full list. These are examples. So Mark Zuckerberg, the founder, sold 30 million shares. Goldman Sachs was an early investor in an investment vehicle. They were selling 24 million shares. There was an overseas investor, Mail.ru, selling 19 million shares. And Mark Pincus is a venture capital investor selling 1 million shares. So this is just an example of the types of early shareholders who get this liquidity event in an IPO. So you can see here, this is both a primary and secondary offering. It's sometimes called a split offering. If it's primary and secondary, it's called a split offering. It means the company is raising some money and early investors are raising some money. Pretty good day for those investors, right? They invested in Facebook and it was just a tiny company. Now it's a giant company. They're selling their shares at a nice profit and they're feeling pretty good. It's a nice liquidity event. Nice time to celebrate. Let's talk about how much of the company was sold. Well, the company, after the transaction, had 680 million total shares outstanding. That's after they exercise what's called the green shoe clause. Well, let's have a little fun here. I can put that in green, I suppose. Right, so after they exercise what's called the green shoe clause, that's done for strong demand. If there's good demand, if a lot of people want the shares, you can actually increase the size of the deal by 15%. That would be up to the underwriters. That's up to the banks who decided to do this. So you can see at the bottom here, Morgan Stanley, they're the lead left. They won the bid. That's where you want to be. You want to be lead left. Lead left means if you look here, they're at the top of the list of underwriters and all the way to the left. That means you won the bake-off. You're taking most of the fees. So if there's strong demand, Morgan Stanley might exercise the green shoe clause and sell more shares. The point I want to make, though, is that post-transaction, let's talk about this. 421 million shares were sold, but 680 million shares are outstanding. So let's think about that calculation. 421 million were sold out of 680 million shares outstanding. So the company, we talked about in the prior slide, are all the company shares sold? Absolutely not. 421 million divided by 680 million is about 62%. So the company sold about 62% of its outstanding stock. What about the other 38%? Well, some of these investors, by the way, might still own shares. Mark Zuckerberg didn't sell all his shares. Mark Pincus didn't sell all his shares. So some of those shares are still held by investors or employees. They remain unregistered, but they are still outstanding shares. They get voting rights. They pay dividends if the company ever pays a dividend. And then over time, those employees will sell some shares. That float will creep up. You know what their float is now? It was 62% when they went public. Now it's about 99%. Over time, eventually all of the company shares will trade publicly. Now, the founder might still own 1 billion shares, but think about this. If the founder owns, let's say a founder owns 30 million shares, and the company has 3 billion shares outstanding, that's only 1%. Still a lot. That person's not unhappy, but that's a 99% float. So you might say, well, can't the founder or the owner still own shares? Sure. But it's going to be an increasingly smaller percentage of the company's total outstanding shares. What are some other ways you can raise capital? Like what the rule says is that securities must be registered with the SEC, like that prospectus, unless they're exempt. You can't just raise capital and not prepare a prospectus unless you find an exemption. And exemptions are offered due to the manner of sale because of a special way in which the securities are being sold, because of a special method in which the securities are being sold. So let's say you're not raising that much money. You can use Regulation A, which as of this writing, you can raise up to $75 million without going through the entire registration process. It's really what's called a limited registration. Which basically makes it faster and cheaper. So that's exempt because you're raising a small amount of money. Regulation D, that's what's called a private placement. That's wealthy investors. You're only offering to wealthy investors. This is Shark Tank. And if you ever watch Shark Tank, you'll probably notice, or maybe you've never noticed, but now you will, at the beginning, there's a disclosure that says the shares are not being offered to viewers or the public. That's because they're only being offered in a private placement. That's why the SEC isn't busting in on set and say, hey, how come you're selling these unregistered securities to Mr. Wonderful and Mark Cuban? Because they're exempt, because you're only selling to wealthy investors. Regulation S is if you're selling securities only overseas. If you want to go to Europe and raise some money, have a party, go ahead. You want to go to Brazil and raise some money, you want to go to Japan, no problem. You don't have to register in the US. You don't have to register those shares in the US. Now, might you have to register overseas? Sure, but we don't care about that for this test. What about Rule 147? That's if you're only selling securities in one state. That's what's called an intrastate offering. So mom and pop in your neighborhood, you want to raise some capital in your small town, the state gets involved. You might have to register the securities at the state level, but you will not need to register them with the SEC. So all of these transactions are for issuers who want to raise money. Now, what if I'm an investor and I own Facebook stock? I'm an employee. I own Facebook stock when it's a private company. Now they go public, but my shares were not registered. Let's say I decide I want to keep my shares. I want to hold them for a while, but eventually I want to sell them. But they weren't registered. Is that a problem? Well, kind of. You think the SEC cares if a Facebook employee wants to sell their stock? Not really, but you still need an exemption. That's called Rule 144. This is basically for unregistered stock of existing public companies. Unregistered stock of a public company. And again, I'm not going to go through all the details here, but let's say I work for Apple and I get paid in stock. Technically, that's unregistered. You think the SEC cares if I want to sell my stock? Not really. It's not that big a deal. So what do you got to do? It's a pretty easy exemption. You got to hold the shares for 6 months, and then you can sell them. Okay, so Rule 144 is not used to raise capital. It's used by investors to sell stock. Now, Rule 144A, of course, the SEC decided, you know what, we'll come up with 2 different rules, same rule number, just add an A on one of them for reasons I can't possibly tell you. Rule 144A, just draw another line here. This can be used by either the company or investors. Let's say the company wants to raise $100 million from one giant hedge fund. It's a big hedge fund. The hedge fund is very sophisticated. You think the SEC cares? The SEC's view is, as a hedge fund, you're responsible for managing your own risk. You have to do your own diligence. The SEC is worried about protecting individual investors. So what Rule 144A says is that unregistered securities can be sold to what's called a QIB. That's a big investor, qualified institutional buyer. That's $100 million in assets. So a big hedge fund or a pension fund or a big mutual fund. And now you said, Brian, well, could an investor use it? Absolutely. If that big hedge fund that the company raises capital from doesn't want to own the bonds anymore or own the stock anymore, you know what they can do? They can sell to another pension fund under Rule 144A. So 144A is used by both the company to raise capital with a really large investor, and it's used by those investors who then want to have a liquid market to sell to another large investor. 144A is very, very common in practice. It's used all the time. It's a huge market. It allows giant investors to trade securities with each other and avoid a registration. And for the test, you definitely want to go through these rules in a little more detail. Again, we're talking 30,000 feet here. So what are my key takeaways? My key takeaways is a company can raise money a bunch of different ways. One of those methods is an IPO. The other methods can be used before the IPO, like a private placement. Post-IPO, you could do another private placement or 144A. By the way, you might say, well, Brian, what if I've already done an IPO, but I want to go back to the public and raise more money? I'm already public. I want to raise more money from the public. That leads to what's called a follow-on offering. Follow-on. That's an existing public company that wants to raise more money. It's a follow-on equity offering. When a company does an IPO, it might allow some investors to have that liquidity event. Other investors will sell their shares later on, for example, through Rule 144, like if you're an employee of Apple or Facebook. And again, after the company's IPO, like I said, there's still going to be some unregistered shares. Over time, those shares will be sold and the public float will increase. Founders will sell shares, early institutional investors will sell shares. So that float, that was the example I gave. Facebook's float was 62% at the start in 2012, and now here we sit in 2024, and the float is 99%. And by the way, you may not like Facebook. I'm not a fan of Facebook, but hopefully you like this video and you found it helpful. It gives you that framework. And when you're continuing to prepare for the test, you want to go back to the rules and be sure you're comfortable with these rules in detail. Thanks for joining us, and we'll see you real soon.